Best money moves to prepare for a recession. Generally, a recession means a significant slowdown in industrial and trade activity, which in turn leads to an uptick in unemployment, a downturn in the real estate values, lower investment values, and a falling stock market, all of which can seriously impact your wealth building progress. But if you're well prepared, you can mitigate the effect on your finances if a recession hits. Here are some of our tips on how to best prepare yourself for a recession. Number 1, budget to continue building wealth. Regardless of the economy, living within your means is the best way to grow wealth. And that means making sure that monthly expenses such as rent or mortgage payments, car payments, and discretionary spending stay within budget so that you still will be able to grow your savings and investments. Be intentional about how you spend your money. Number 2, build an emergency savings fund. To recession-proof your finances, you really need to prioritize building an emergency fund. Put aside at least 3 to 6 months of your basic living expenses to mitigate the risk of unemployment. Once you reach 6 months, you can start working toward 12-month emergency funds. When you're calculating your essential expenses, remember to add in everything you need to get by in your normal daily life, like groceries, housing, utilities, and transportation. Number 3, diversify your investments. Having a diversified investment portfolio is crucial to preserving and building wealth. So, one of the most important things to do ahead of an economic recession is to ensure that your investments are evenly spread and your cash isn't tied up all in one place. Spread your investments across multiple industries and holdings to ensure that a dip in values in one area of your portfolio doesn't negatively impact the overall value. Most investors already have company 401ks, separate brokerage accounts, real estate, and even business investments. We've found the most stable, recession-resistant options to be in commercial real estate syndications, like multifamily apartment complexes. Number 4, pay off high-interest debt. The last thing you need is to stack up high-interest debt to pay off. If you can pay off any high-interest debt you currently have, you can potentially save a lot in interest payments. Then you can put that extra into boosting your emergency savings. If you've been wanting to refinance any of your larger assets for lower payments or secure lower rates or maybe better terms, now is the time, not once the recession hits. Typically, banks tighten policies during tough economic times, making it even harder for consumers to get on their feet. Preparing for a recession is by no means impossible, but if you see that there may be tough times ahead, begin to take steps and get prepared to ensure that turbulent times don't derail your financial goals. Thank you for watching, and if you want to get started building your wealth with passive real estate investing, visit us at www.starboardequity.com and schedule a quick investor call with us. We'd love to talk with you. Thank you.